everyone, and welcome to ICM's education webinar. It's the 6th episode of Path to Professional Trading that we're providing to increase your knowledge about trading. So today we decided to talk about price action and trading psychology. I'll be talking about different price action strategies, and my colleague Sai will be also giving some great advice on trading psychology. So first, let's start with price action in general. It's just the definition of it is it's the movement of a certain security's price plotted over time. So it's just very basic. It's a price action. It forms all the basis for a technical analysis of a financial instrument. So what we do usually is that we rely on for a technical analysis, we rely on the chart alone. So one of the key pillars of technical analysis is that the price discounts everything. So a trader will be only looking for the charts to take any decision over his trades. There are a couple of types of analysis to do in technical analysis. There are a couple of schools, among them the classical, technical, harmonic patterns. We can go for indicators, oscillators, and others. And there are some just approaches strict to using price, which could be the price action. So a trader would be relying solely on the price. So they would be looking for certain reversals, and just looking at the price. It's mainly speculators rely solely on price action, as we said. So what's a price action? Continue. It usually creates patterns. So we know that psychology affects the market. So a trader's emotion will lead him to take certain decisions. I believe that these emotions would lead to certain patterns in the market. So the behavior of a client will be repeated. So a couple of clients will have the same behavior towards a certain event, and the emotions erupting from this event would lead to certain market action, and this market action would create patterns. So a trader will be looking for recognized patterns, and they could be harmonic patterns, they could be classical patterns. So by these, or even they can look for very simple stuff. They can use, for example, Renko charts for like grid trading, or they can use the candlestick patterns. They could also use different chart types, as I said, to make it easier to interpret trends, breakouts, and reversals. A key limitation for price action is that it's very normal and realistic for two traders to have different conclusions when studying the same price action. Mostly, technical analysis, while applying technical analysis, you'll end up with two scenarios. It's either a bullish scenario or a bearish scenario. Sometimes we go for additional approaches similar to fundamental analysis to try to add some weight on one of the scenarios. So it's going to be more a preferred scenario and an alternative scenario. But for traders who are solidly relying on price, they could be like two traders assessing the same chart, the same price formations. They could be, for example, coming out with different deductions or different analysis, leading to different also positions. So one of them will be buying a security while the other will be selling a security. So this is what's a limitation for price action. And you can't tell which one of them is correct until the market takes the move. A better understanding for fundamental analysis can support the trader to have better assessment, thus forecast. This is what I was just mentioning a while ago. So among the price action strategies, one of the simple price action strategies that a trader would use, we can use candlestick patterns. We had a session last week about candlestick patterns. We talked about single patterns, double candlestick patterns, and triple candlestick patterns. You can watch the rerun on our YouTube channel. So by this, a trader would be only relying on any patterns coming out from the chart, like candlestick pattern, bullish engulfing patterns, bearish engulfing patterns, morning star, evening star, doji, soldiers pattern. So they'll be looking for these patterns and trading the patterns solely. Also, traders could use trend lines and channels. Also, we talked about classical technical by drawing trend lines, how you can draw a trend line, how you can draw a channel and benefit from signals of a channel. I'll be applying these strategies on the chart in a while. Continuation and reversal patterns, they are the patterns that are most known. So for example, for continuation, we can have, for example, the market's going up. We have here a triangle, a symmetric triangle, and then the market, for example, the market is moving up, and then we're left in a certain triangle. So this triangle is a continuation, and then the market continues. So this is a symmetrical. Also, we have, like, for example, the ascending the triangle We also have descending triangle, which is the opposite type of ascending. These are, for example, the most known continuation patterns. We have also the reversal patterns, the head and shoulder pattern, which could also lead to a certain drop in the market. So, for example, here you have a certain trend line from previous, and then here also you have the neckline, and then the market is reversing following a certain move. Also, we have the double top patterns. For example, the market is moving like this, and then we have this movement, and then the market drops. And also we have the triple top and triple bottom. So these are among the continuation and reversal patterns that a trader could use while applying price action. Psychological levels. So for example, let's say gold is trading near almost 1900. So a trader would think that if the market drops below 1900, this level 1900, for example, the market is trading like this. So if a trader believes that the market is going to drop below 1900, it's going to continue. So they'd be taking a short position here and targeting further lows. Vice versa on the upside. So for example, now the British pound was trading above the 130. So this is the 130 level. So we're trading like this below it. So if a trader believes that the market's going to move above 130, again, it's going to continue to the upside. So also they would be trading psychological level. Mean reversion, we have, for example, a certain price movement. This is the chart, and we apply, for example, a moving average on the chart. So this is how the moving average could look like. What we mean by mean reversion is that the market is moving away or diverging from the center or from the average, and at the time it will come back to this average. So a trader would be looking to short positions here to go back to the middle, and also buy here, for example, if it was lower. Short here, and then going long here and going short here. So they're looking for extremities and selling and buying extremities in order to go back to the center or to the middle point, which is almost the mean. So this is what mean reversion means. And also a trader, for example, who's applying mean reversion, he could add also some of the candlestick patterns to take more better decision. Grid or Renko, the one that I just also mentioned a while ago. So for example, there is a trader that would say, if the market moves in certain levels, 30 points, 30 points, 30 points, I will be selling here. This is my first sell, this is my third sell, fifth, I'll try building a position because I believe like the market's gonna move like this, and then the market's gonna continue down, so he'd be building a position without setting a certain stop loss and moving to the downside. So his average, for example, his profit, his average price would be somewhere like here, and he'd be benefiting. This is a grid Renko, or for example, the Renko chart, it's just boxes. So these boxes, they show certain price action. So for example, each of the boxes is like for 10 pips. So a trader would be selling for every 10 pips a certain position. So also this could be one of the strategies that a trader could use. So simply, these are among the most well-known candlestick price action strategies. So I'm just going to move to the MetaTrader 4 platform to show you how you can apply these strategies on your MetaTrader 4 platform. So for example, let's take into consideration we're trading the euro dollar. So as easy, we started with candlestick patterns. So this is one of the key candlestick patterns that was available in front of us. We can see a bearish engulfing pattern. This bearish engulfing pattern, it signals that the market is going to go down further. So you go for selling a position here, initiating a sell position with a stop loss here, or even at the previous stop. It depends on your risk appetite. And then here we can see that the market slided and fell almost around 70, 80 pips. So this is just a small example of how you can use candlestick patterns in trading and taking certain trading decisions, or just relying on candlestick patterns to take decisions. Also, the other one, we talked about trend lines and channels. Also, you have, for example, if we just set like this, we have here the market is trading within a certain trend line, and then now we're trading near this trend line. So the trader's yield would be having two decisions. So that's what we mentioned. So this trend line, a trader would think of buying here, while a trader would think of selling here. So this is how the limitation of price action that we talked about. So a trader here would have to decide on what is his next position by using only this trend line. So the trend line would split the market into buyers and sellers, on the buying decision, selling decision, and you have to choose which side you are at. Also, by using the same chart, you can apply also some of the patterns that we talked about, the continuation and reversal patterns. So for example, here we have a certain pattern formation. Usually it's a continuation pattern, it's a triangle, which are most known for being continuation patterns, but still the triangle was broken from the downside, and this attempted to move to the downside, and then the market continued lower. So this was just painted here almost the same. So you can also, if you want to go for a certain channel, you can just draw this. You can see how the market exactly dropped to this bottom, since this one is equal to this move here. So you can see how the market moving. So only with the same chart, we're using the H4 chart on euro. We're able to use either candlestick patterns, either the trend line, or the continuation or reversal patterns, the classical patterns, to take a decision on a certain trade. Also here, you can, for example, trade a certain psychological level. For example, 120 level, which is a truly psychological level, is one of the rounded numbers. So you can see here when the market goes towards 119, the trader would think that the market's going to be facing some serious selling pressure, and this is what happened exactly. So when the market moved towards 120, it triggered some heavy selling power, and the market moved down accordingly. And now we're trading lower than the area that we were trading ahead of reaching 120. So this initiating the selling power, and the market dropped almost 400 points since then. So this is also on the same chart, we're applying the same thing. Another one, if we just add a small indicator here, it's a moving average indicator. Trends, we just choose any moving average and we go for, let's say, 20 period. You can see here that as the market is moving away from the moving average, it's coming back to the mean. So this is the mean, and the market is moving back to the mean. So here, this is, for example, the trader would be selling these moves here. So if he's using also candlestick patterns to filter the moves, he would be starting a selling position here towards the mean again. He would be starting a selling position here towards the mean. A trader also would be, for example, if he's trading on the extremities, so he's looking for exhausted trades. So here it just he missed it since he didn't get a certain reversal. For example, here we had a reversal formation, we have a hammer, and then the market moved lower. Also here, we had a sort of a bullish engulfing candle, though it's small, we had a certain sideways move. Even here, it was almost a full candle, and then the market moved lower. So this is also how we can implement the reversion to the mean by only on the same chart that we also applied other strategies on. Also, you can use, for example, the grid or other strategies, like if we're just gonna use the same chart, I'm not gonna go for a Renko chart, you can just every 30 pips, for example, you can set a certain level. For example, let's start from 118, and then the market was going up here, so every 30 pips you'd be looking to initiate a sell position. So if you start building a certain position and the market is moving up, so every 30 pips you initiate a sell position. So here you ended up almost with this one, you missed it, you took this one. So for example, if you were taking small positions here, for example, you started with the 0.01 and then go for 0.02, 0.03, your average is almost here, and then the market dropped all the way down and you earn profits. So this is also how you can use just the price solidity to take certain trading decisions. This is a small example on how you can use price action strategies in order to take your trading decision. Now my colleague Sai will be explaining to you all what's about trading psychology. Sai?
Thanks, Wael. Hello to everyone. Hope everyone's doing good. Let's move to trading psychology. Trading psychology, it's also one of the important factor for any traders, like very important to notify like how your psychological behavior on the trading. So here, for example, like you take for your success or failure as a trader depend on your emotions. So emotions plays a major role in a trading, any kind of trading, any type of traders, any category of people who trade in the markets. You may have a brilliant trading system, but if you feel arrogant and threatened or upset, your account will be sure to be suffer. So the emotion plays also a major role where to be careful on test yourself how emotionally you are attached to the trading and what kind of so we're going to see a different type of psychological factors which really is going to affect the markets on the trading. Sorry for that disturbance. The main psychological factors in trading, reality versus fantasy. A successful trader is a realist. He knows his abilities and limitations. So basically, when talking about the realities and fantasy, so many traders have this comparison is very important for any traders basically. He analyzes the markets without cutting corners, absorb himself, and makes realistic plans. So the unstructured environment of the market make it easy to develop the fantasy. So basically, the reality is a very important in trading. So many traders who always keep their mind on trading when they get into the markets, maybe a beginners or maybe intermediate experienced traders also have faced this type of psychological effect in the markets. So when you're talking about a different kind of a psychological myth, one is a brain myth. So basically, any trader comes and says, he feels in that way like I lost because I don't know the trading secrets. Many have fantasy that successful traders have secret knowledge. It's not like that. Basically, it's like a brain myth is very important because you yourself should not understand that there is some secrets are involved in the market. So only the traders who have secrets, they do the success. So that's the most important myth is kept on any traders who really have failures been seen on their type of trading. So next is that uncapitalized myth. So many losing traders think that they could trade successfully if they had a bigger amount. So that's the main thing. So even a smaller amounts will start with a proper risk management or proper strategy or keeping the psychological, emotional in touch. So that makes a real success. But many loser traders always think that my size of the account is very small, or they feel that they don't have any sufficient amount to have a bigger amount to trade in the markets. A trader who wants to survive or prosper to must control losses. That's most important thing, that because the only that comes out of like keeping a strong strategy, a strong risk management, and testing, keeping your emotion on tight. That's most important thing to control your loss. You do that my risk in only a tiny fraction of the equity of a single trade. That's most important thing, and definitely we're going to coming up with all trading more strategy on a coming webinar, like talking about discussion about how to trade and what kind of percentage to be trade risk on each and every trade. Risking a tiny fraction, for example, the percentage wise, that's most important thing. So keeping a leverage into the line and margin onto the control and keeping a risk capitalization was very important to each control with a single trades. Learn from the cheap mistake in a smaller account. That's most important thing. As if you are beginner in the trader, as you are a beginner in the market, so now definitely you have to start with any amount as you are capable of taking a risk on that particular amount, and try to implement or try to keep on your a smaller amount of risk, and try to test yourself, in a different level of different kind of strategy on a smaller accounts. So that is most important thing, because capitalization is a very important myth. It's always in the keeper's trader's mind. Autopilot myth. That's also one of the uptrending myth, which is normally traders who comes with a auto trading or maybe a robot trading or a signal provided traders. So they keep that. The traders who believe in autopilot may think that the pursuit, the wealth can be automated. That is also one thing, because the system computer itself trade for them, and end of the day they check how the profit loss has been accumulated. So that also keeps that, because when you go into the auto trading, that's most important thing. You have to test properly. First, initiate your test with a demo account, with your actual realistical virtual amount, and test what exactly it is, and keep watching for at least for a month time, and check it out how risk is involved in that, because each and every auto system has their own system, own program, own coding has been designed as per the market's move. So every month market doesn't have the same way of movements. For example, last month the market was a trend on one side, and maybe this month maybe consolidation will be seen in the markets. Even the same auto or a robust system which cannot work on the same different on a different month with the same result. Maybe last month it have given you 10%, 15% different level of percentage of return, but this month would have given us some loss side of this. So this is also a myth for the auto trader, which has to be more psychological things to be think on the trading. Trade with your own eyes, eyes open. The successful trader cannot afford wishful thinking. It must be a realist. So there are no cheat sheets in the markets which can see the truth in your trades, diaries, and equity curves. To win the market, you need to have the master three essential components of the trading. The most important thing is to be notified is that one is sound psychology, a logical trading system, effective risk management. These are the major important factors or essential things to each and every trader to be focused. So the sound psychology is nothing but the testing, the emotional testing, the fear, the greediness, which all also involved in this. When you're talking about logical trading system, the strong trading systems should be strategies to be planned, and because there are many, like if you take for a trading strategy, like there are many type of trading strategy based on your risk capacity. And again, it's a risk management plan is very important, like how much margin you take into the markets, how much trade you can do on this, your balance amount, what is each and every risk to be taken on each and every trade. That's most important things to be taken care when coming to the trading risk management plan. Let's move on to the next is the bending the rules. You need to make trading on objective as possible. Be sure to follow the money management rules. Keep your spreadsheet list on all your trades. That means your test, you check all your trades, what happened to the trades, each and every trade, how this trade has been executed, whether you've been followed with the stop loss, a target, whether the target is achieved. For example, you made a trade of 10 trades in a day or maybe in a one instrument. Check it out each and every trade and keep your list on every time, and try to check on every day basis how the trade has been executed, what are the reason has been at risk, and how it has been how many trades has been success overall, what is the profit ratio of your trades, what are risk is involved in. This is the most important thing to each and every trader has to check the spreadsheet on all your trades. Coming to the next is emotional trading. Emotions are the worst enemy of the markets, and learning how to diminish your impact on a decision making rather than task you achieve through their years of experience. Even many experienced traders will lose emotions because due to fear in the markets, maybe they also have a certain circumstance which affect their emotions, to test. Even strong traders, I mean, experienced traders also face this kind of emotional kind of things, which really are worse to the market traders. Basically it's affect the entry trading strategy. There are 5 common emotional mistakes that traders makes. All of them have been potential to lead the massive losses, meaning you should be best or overcome them. So those are the sensitization of your greed, the fear, the revenge, appearance, and pride. So as I said, that these are the most important things to be careful when you have completely into the emotional trading. So because the greed, it leads you to have more exposure in the markets, because when you see the profits on the one side, you try to jump in many times in the market without any plan on your risk management, or as I said, undercapitalized. I mean, for example, you are leveraging more onto the market. This also will be a more risk for any type of traders. Even fear, when you have been seeing many losses continuously and consistently, you've seen a loss, and that makes you more fear on the market. So this is also a psychological thing that emotional trading is very to be tested each and every traders. So coming to the individual psychology, a trading psychology refers to the emotions and mental state of the help to detect the success to the failure in trading securities. Trading psychology represents the various aspects of individual characters and behavior influence of the trading action. That's most important, because this is not even involve a type of group of traders. It's also involved to the individual psychology, because if I'm trading in the markets and I'm into the positions in the trading, so that also be as individual characters. So how exactly you impact, how exactly you react to your position. For example, when you have open your position just like that without any plan, that will also gives you a lot of psychological things in your market, because that will impact your occur a trading loss on your market. So mass psychology, that's different type of traders are there in the market. For example, huge crowds trade on stocks, commodity and forex exchange. Because you can see that the market has a huge trillions of volumes involved in it. Definitely there'll be different type of traders will be there in the market. For example, if you take a big money, a little money, a smart money or a dump money, or institutional money or private money, long-term investors or short-term traders, all made in the exchange. Obviously there'll be huge type of volatility will be there, and definitely a small trader which are going in a bigger market, definitely a huge risk is involved in that. So you should be very careful on this. So this is also a big psychological move in the market, because it impact any factors, any type of news impact will be there. even institutional traders are there, social psychological tradings will be there. So these are more important things like a psychological which has a huge crowds, which really has a very volatile and which cannot be expected what exactly the market is be. So that's most important thing to be carefully taken care, which is a huge crowd or huge play or huge kind of volume will be reacted in the markets. So when I continue the journey to become a successful trader, this is most important. I think a few points has been given in a very good way, like nice to understand, easy to understand how exactly a successful traders can go with it. Decide that you have in the market for long. That's most important things. Many traders comes here, they want to make a quick money and they want to go away. No, that's not exactly things. They have to plan for a long term. For example, you come with a smaller money or bigger money, you have to have a proper plan that thinking for 6 months, 1 year, 3 months, 3 years or something like that. So be that you are, keep your mind that you are in the market for long term. So you will have a lot of knowledge will be coming out, because each and every day you try to understand new knowledge, new understanding about the market to improvise your trades. Learn as much you can. So that's most important thing, like you learn as much, because the market is a very vast subject where you try to learn in a different way and different way of today you trade in something in a new strategy. Definitely it's good to upgrade yourself to increase your knowledge. So learn as much you can. Do not be greedy or rush to the market. That's most important thing, because everyday market has a fluctuation, everyday market has a movement, every day has market has momentum to give the profit side or potential things are there. So it doesn't mean market has moved only today. It has a possibility to move every day, even in a different way of ups and downs, like a bullish or bearish. So don't be greedy or don't rush in the market as market has jumped this much, I miss a chance to get the opportunity. No, it's not like that. So it doesn't go into greedy kind of things to rush into it. Understanding the fear, that's most important thing, because the fear kills your account completely. So you have to understand what kind of fear you have. Because if you have better strategy, if you have better type of risk management, nothing to worry about it. It can be overcome your fear. So try to control your fear and try to understand where the fear you have been initiated for you to trade start the trades. So develop your method of analyzing the markets. So that's most important things. So you have read, you are going through many kind of things to getting into the markets. You learn many things. Maybe it gives you knowledge. So keep analyzing the markets as much you can, both in a technical side or fundamental side, or even it can be on a psychological side. So that gives you more knowledge. So keep learning on a daily basis, or keep learning on analyzing your markets on a regular basis by keeping the history, how exactly, because history also plays a major role in the market regarding the support, resistance, important about the levels where the market's been giving a new highs and new lows. That's most important thing. Developing your money management, that's most important thing. Like that's a very important, because based on your capacity, risk capacity, this money management plan has been created or designed as per that. So as per that, you can keep your risk factors, or how much risk tolerance you can be able to take in the markets, or to the balance amount. So this is also one of the important points to be notified the successful traders. Drive, knowledge, and discipline. That's most important thing. What are you know? What are you doing? Like what do you understand? What have you been experienced? More stop important thing. Get more knowledge and be as very disciplined in the markets. Thank you for all.
Thank you so much, Sai. If you have any questions, please write them down. Okay, perfect. Thank you all for joining.